In a world where every penny counts, the recent 0.2% rise in the cost of goods and services might not seem alarming. However, beneath this seemingly modest increase lies a story of persistent economic turbulence. Inflation, that invisible yet relentless force, remains perched above 3%, a constant reminder of the challenges we face. The question looms: when will we return to the pre-pandemic era of stable 2% inflation? It's a question that not only affects economists, but every person who balances a budget. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So, before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. In July, the cost of goods and services edged up by a seemingly mild 0.2%, an outcome that economists had anticipated. However, the broader picture remains concerning, with overall inflation stubbornly above 3%. This steady climb in prices over the past year has now reached 3.3%, up from 3%, according to government report. While we've witnessed a notable slowdown in inflation this year, it seems we're a long way from returning to the comfortable 2% levels seen before the pandemic era. Of particular interest to the Federal Reserve is the core PCE rate of inflation, which also saw a 0.2% increase last month. This metric, which excludes the volatile food and energy sectors, is considered a better indicator of future inflation trends. Over the past year, the core inflation rate has edged up to 4.2%, a slight increase from the previous month's 4.1%. While these figures may not set off immediate alarms, they also don't signify significant progress in aligning inflation with the central bank's 2% target. As we navigate this economic landscape, there are potential consequences. A slowing inflation rate in 2023, coupled with intermittent signs of a cooling labor market, might lead the Federal Reserve to hold U.S. interest rates steady at their current range of 5.25% to 5.5%. The Fed is set to convene in September to make this crucial decision. Striking the right balance is critical. The central bank aims to quell inflation without plunging the economy into a harsh recession. Wall Street investors seem to bet on the Fed maintaining the status quo in September, opting not to raise interest rates. The question that lingers is whether this will be a prolonged stance. The answer hinges on whether the steady deceleration in inflation endures. Recent surges in oil prices have placed upward pressure on inflation, and wages continue to rise faster than the Fed prefers. George Mateo, Chief Investment Officer of Key Private Bank, commented on the situation, saying, "The PCE report released today revealed no major significant acceleration in inflation, which the Fed will view positively. Given the continued strength in the labor market and the fact that the economy is still growing above trend, the Fed will view inflation as cooling but not sufficiently cool." In response to this economic data, market movements have been relatively subdued. The Dow Jones Industrial Average and the S&P 500 made modest gains in Thursday's trading. The yield on the 10-year Treasury note, on the other hand, dipped slightly to 4.1%. So, where do you stand on this? How do you think we can navigate this delicate balance between taming inflation and fostering economic growth? Share your thoughts below. Share your thoughts in the comments section below. And remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.